Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Hey, welcome back. This is Todd Taskey. I am the host of Second Bite Podcast, where we get a chance to talk with top entrepreneurs and CEOs about creating, building, and then selling valuable companies. And people really seem to love this podcast because we talk with non-famous CEOs who have built companies that perhaps you haven't heard of for 7 or 8 figures. And in many cases are still working at their company, working and focused on a bigger and better second bite. And today I have with me Jeremy Weiss from Rise 25, who will be our guest and is going to flip the script a little bit and interview me for this segment. Jeremy?
Todd, I'm excited because today we're going to talk about the 3 biggest considerations with your second bite. How do you increase your chances with the second bite? So listen up. And before we get into it, this episode is brought to you by Potomac Business Capital, where, Todd and his company, they help businesses in the lower middle market maximize their value. Who doesn't want to maximize their value, right? By putting a unique twist on the typical banking process and, have a big impact on the world. Over the past 15 years, they've perfected their strategies for M&A advising, exit planning to guide clients through everything from the pre-deal planning to the closing and everything else. You can check out more at PotomacBusinessCapital.com. You can email Todd personally with Todd@PotomacBusinessCapital.com. And I'm excited about this, Todd, about the 3 biggest considerations with the second bite. I mean, 2 people I want to give a shout out to. Okay. Your daughters. So they better spread the word on the show, right?
Yes, they both have promised me to do so. I'm not sure how that's going to help us, but I'll be famous in that small niche of the world.
It's all that matters. So 3 biggest considerations with the second bite.
Yeah, there's really 3 ways to get paid on the back end of a deal, right? Or on any deal, you get your cash up front, your consideration up front. And then you either take a seller note, which is probably the least common of the 3. There's an earnout component where you have to do a certain amount of performance over a certain period of time to get a certain amount of money. And then there's taking part of your consideration in equity, which people call an equity roll forward. And then you take a piece of the new company or the larger company.
Before we dig into each one, as you know, I talk to a lot of entrepreneurs, as you, and they're always saying how you just don't count the back end. Whatever you get up front, just pretend the back end doesn't even exist. And whatever you get up front is really what you should count on. How do you frame that? How do you think about that?
It's super common, that belief. I can tell you we've collected a few trophies over my shoulder here, and almost all of those have a back end to them. And on almost all of those, our clients have gotten 100%, and in some cases more than 100% of what expectation was in their earnout. So if you put a lot of energy and effort into your documents, right, and the legal structure around the back end of a deal, and you have experience and think it through properly, you absolutely should expect and count on getting all of that.
How do your clients seem to have a higher percentage? What are some of the things that you do or recommend?
There's 2 things that never show up, but are really, really important. Number 1 is to have a very, very good strategic fit in terms of the transaction. And I could give you bunches of examples. Maybe we'll get into some as we talk. The second one, though, is you win this game at the LOI stage, the letter of intent stage. And no matter what the real circumstance are, the buyer should feel like they have won the lottery when you selected them to sign the LOI with. They should be high-fiving each other, around the office, because as you go through due diligence, undoubtedly there'll be bumps in the road. Undoubtedly there will be things that they didn't understand like they thought they understood and what have you. But they need to be so convinced that there's a ready market out there for somebody else that's going to jump on this thing if they don't close it in the 60 days or so that they have. that is just so critical, and it makes the job of going through due diligence so much easier. It is maybe the most important thing to making sure your deal closes and that your back end turns out the way you want it to.
Talk about the strategic fit piece, because that's going back to choosing the right partner in the beginning.
Yeah. So one of my favorite examples, we sold a company 3 or 4 years ago called RuleTech. And we sold it to a public company in India. And our guys did BPO service, business process outsourcing, and they did it around Pegasystems. The buyer really wanted them because they had no expertise around Pegasystems and they needed it. They had inbound demand coming for it. They wanted US presence. They wanted the clients. They wanted the people that we had, the employees of the company. And they didn't do it at all. So they were so dependent on my guys to perform post-close, and they didn't want to get in there and mess around with it. So in that deal, our guys were paid. It was actually a very interesting structure. So that particular deal, we got paid on a formula basis that included both EBITDA and revenues. And so the deal was closed. At close, our guys got 55% of this formula. And then next year, they got 12.5%, and then 12.5%, and then 20% in the third year, based on the performance of the current year. And so we projected that they would do 20% a year in growth. They actually did 27% the first year. They did 35% the second year. And we're on track to do 40% when COVID interrupted some of their performance, but they still outperformed their 20%. So that's kind of an example.
Todd, I'm thinking this through for a second. Maybe this is a whole separate episode, but criteria for a great strategic fit. You mentioned one, lots of inbound demand, right? Mm-hmm. 2, they don't do it, right? So they're going to depend on your company. Are there any other criteria that come to mind with a great strategic fit?
Yeah. So I closed a deal on Friday, as a matter of fact, and our guys do email marketing. And the acquirer was a large inbound agency, a HubSpot agency. And their premise, their thesis is that we want to be very strong. If you look at it on technology, HubSpot, Klaviyo, Marketo. Before I ever showed up, before my client ever showed up, this is what they were going to do. And they wanted them in a certain size with a certain capability set. My guy was a great fit from a capability set. He's a great entrepreneur. They're 100% recurring revenue. They're growing. They're doing all those things. And those guys said, that's the group we want. And so it kind of fulfills their mission of how they're going to grow and build that company so that their second exit will be a significant one.
So for that particular company that's acquiring, they have a HubSpot and they have a Klaviyo, but they don't have a Marketo yet?
That's correct. So my guy was the Klaviyo piece.
So I'm just putting it out there. If anyone knows of a great Marketo agency that does marketing, then you should probably contact Todd, and he may have a possible deal for you.
Yeah,
is that accurate?
Right. And here's the other thing too, just to feed off that for a second. When we signed that transaction, we had 2 other buyers, really good buyers, that were very interested in that business.
In the Klaviyo one. Yeah.
Now, they wouldn't say the Klaviyo business. They would say the email marketing firm, right? Because they don't even care about the platform. They care about the service. So these guys, so now I've got 2 that A, just missed, and B, now realize, maybe we'll have to pay a little bit more, because they wouldn't move up to, and ultimately it wasn't just a financial decision. But I got 2 groups out there, and I say I have them. There's 2 groups I'm aware of that just missed, that are really good buyers, that made good offers. And when you can find a buyer at a time like that, that's a great opportunity to be in front of them. So even if you're even if you're not a Klaviyo partner, right? If you're an email marketing firm, that's the type of strategic fit and the perfect type of timing that makes a deal just work great.
I love it. So if you're email marketing agency, then you could contact Todd.
Yes,
or any agency for that matter. But
really, any agency.
I guess the people that you work with, Todd, what range should they be above for it to make sense to contact you?
Most of our guys are between $1 million of EBITDA and $4 million of EBITDA. So in that range is where we most typically deal.
Got it. So back to, we have seller earnout, seller note, equity roll forward, and seller note you said is not as common. So I don't know if you wanted to get into that and all, but let's start with the most common one, which I think you talked about is the equity roll forward. Is that the most common out of the three?
Yeah, I would say it's probably almost an even mix. It depends who the buyer is and how they feel about giving up equity in their company or not.
So what would be an example, and you have to name names if you can't share names, of equity roll forward?
So again, the transaction we just did Friday, they rolled forward half of the equity, half of the value of the deal, right? In many cases, it could be less. That was a desire that they had. But to your point from before, if you're $1 million of EBITDA and you have a lot of recurring and you have good retention and a whole bunch of other things, maybe your business is worth 6 or 7 times EBITDA, right? And so the question is, how do I get my agency to be worth 10 times EBITDA, right? How's my business become more valuable? And the simple answer in that case, if you want to be worth 10 times EBITDA, you need 10 million of EBITDA, right? You got to be there. And if you're at $2 million and you want to get to 10 million of EBITDA, that could be a lifetime's work. So as I often say to clients, and we'll use this one from Friday as an example, if your chips are worth 6 times, take what you need to off the table or what you want to off the table, and let's see if we can take those other chips, in this case, $3 million, and exchange them for those chips. Because those guys are almost already at 10 million of EBITDA, and their intent is to get to 20. They've got professional money, private equity, very smart money behind them. They've got a really good agency already that they're growing from. If I had to place a bet on who's going to get above 10 times EBITDA quicker, my client or the guy who's the buyer, right? Because they just got so much stuff already in place to make that work.
Yep. And then we were talking before we hit record, and you were talking about some differences between share class, stock waterfall. I don't know if you want to get into some of the nuances.
Yeah, so nuances are so critical and they vary a great deal, but let me give you an example. And so this is a transaction we were doing a while back. And if you're listening and you want to jot numbers down, it might be a little bit easier. But we were being acquired by a group that was owned by private equity. And so private equity had put in $10 million. Private equity also had a preferred return on that of about 6% or 7%. Okay. Which meant they were going to get $600,000 a year in interest on their money. This is very common for private equity because they've got investors. That's how they raise money. They do all this stuff. They don't take it currently. They'll just accumulate it. And then when they sell the business, they'll take it at the end. The portfolio company they had, the founders of that business rolled forward $4 million. Okay. And so let's assume it sells at some point in the future where that accumulation of interest or private equity is $4 million. Okay. So when we sell the business, in the way that this deal was structured, the private equity group and the portfolio company both had preferred shares. So at the time of sale, there's 10 million to private equity plus their 4 million of interest. And then there's the 4 million of equity for the portfolio company. So that's $18 million. Okay. Now, in this case, my guy had $3 million of equity. Okay. So here's the big question. And this goes to share class and to waterfall. So when you sell the business, and this is how the LOI was, the deal documents were originally written. They wrote it that said, at the time of sale, we get our 10 million, then we get our 4 million of interest or whatever the interest would be. Then the portfolio company gets its 4 million of equity. Then, and this is the critical point, then the rest of the money gets divided based on ownership. We said, well, wait a second. How come we don't get our 3 million bucks first? We should be preferred, right? It should be your 14, your 4, then our 3, and then divided by the rest. So let's go through simple math, right? And gradually we worked that out, right? That was a big, long fight over a long period of time. We had good lawyers. We had a good buyer, so it all worked out. But let's assume we sell the business for $60 million. Now, when we rolled forward our 3 million bucks, we got 8% of the company. Okay. So we sell the business for 60 million. Private equity gets their 14. Other guy gets his 14. That's $18 million. What's left over, if we get 8% of what's left over, that's $3.36 million. Okay, about what we expected. And to be fair, it's about where the company was at the time we closed the transaction. Maybe it was a little bit less. But if we got it the way we did, then what happens is when we sell it for the same 60, 14 to private equity, 4 to company, the platform company, then we get our 3.
Based on the higher number. So the 8% is based on the higher number.
Well, so let me make sure we're clear on it.
Or based on the higher number, because it's a higher number because it's the total 60 minus a lesser amount.
Well, no, it's actually minus a greater amount, but we get all of our 3 million bucks. So in the first deal, there's 14 plus 4, that's $18 million. And then the balance, which is what, 42 million bucks, is what's left over. And we get our 8% of 42. And the second one, 14 million, 4 million, and then our 3, 100% to us. So we get our 3. Now it's not 18 million that's been paid out already, it's 21 million. The balance, which is 39, then we get our 8% of 39. So we get 3 million plus 3.1 million as a share. That's 6.1 instead of 3.3.
It's a big difference.
It's a big difference. It's a big difference. And you better know this. And again, if you've been through it before, you ask these questions when you're signing the LOI, right? What's your capital stack? Who's in the cap table? Who's got preferred? Where do we stand? All those things, right?
Yeah.
So,
no, I love that.
So that is 2 sentences in an 80-page document. Those 2 sentences make a $3 million difference. Have a good lawyer, my friend. Have a good lawyer, right?
And so that will be the example of share class and stock waterfall that you were mentioning. Yes. And then earnout, how you do it in a stair step so it's not a cliff. You want to talk about?
Yeah. So earnout, right? So I'll use an example, and I jotted some numbers so I'd get them right. So let's assume you do your deal, right? And let's assume the buyer is not giving up equity, or you don't want the equity or whatever, right? You want to get a chunk now, get my chunk over the next 2 years, then I'm going to be on to whatever I'm on to next. So let's just assume that they're going to pay you whatever you got to close, 2 million in year 1, 2 million at the end of year 2, and then you're done. And let's just make it up and say you have to do $1 million of EBITDA in each of those 2 years to get your 2 million bucks. So the question becomes, what if you do 990,000, right? Do you get it? Do you not get it? And on like that. So there's a couple of really important things first. Number one, you must have control of operational control of the business. And typically, you want to have in your documents the ability that you have the right to operate the business in the way that is consistent with your past practices. Okay. What you don't want is the mothership saying, hey, you need to be doing HR the way we do it. We're going to charge you $75,000 for the HR work and another $80,000 for the accounting work. Right. So that's an important thing. So now we got to get to $1 million. What we will often do is stair step it up to that number. As an example, let's say the minimum is 800,000 of EBITDA. That's when we start to get paid up to the $1 million that we want. So that's a $200,000 difference. And we're trying to get an earnout number of $2 million. Or think of it this way, for every dollar of EBITDA, if that's the measure, for every dollar of EBITDA over 800,000, we get $10. So if we got to 990,000, that's 190,000 over 800. Take 190,000 times 10, and what did we get? 1.9 million. Excellent. Right? Better than getting zero. Now, as an example, another way of doing the exact same thing, make the initial hurdle be 600,000. And so now there's a $400,000 difference. So for every dollar over, we get $5. Now, if I'm the buyer, I'm like, listen, I didn't buy a company that's going to go back to 600 grand. You do 600 grand, this has been a disaster for me. I'm not paying you anything more. So you negotiate over the hurdle rate. A real big key is the ability to make up or catch up. So for example, we got 1.9 million the first year. What happened to the other 100? I want it to go into the pool for next year. Right? And so next year I can earn 2.1. What if the number I had to get to $1 million? What if I got to like $1.2 million? Most places, most buyers won't pay you the extra, but I'd like to get that 200 again I'd like to start the year with 200 already. Right? And
it rolls over.
It rolls forward. Exactly. It rolls over is a better way of saying it. And so you start there. And the reality is, and this is how we win this argument all the time. What do you think is going to happen when we get to December 10th and I've already hit my number for the year? And I know any additional EBITDA or gross margin or whatever the measure is just wasted. What do you think I'm going to do?
Wait until January 1st.
I'm going to do what all great salespeople do. And I'm going to put on the brakes and I'm not going to shovel more money through. And now you get adults acting like children. And nobody wants that. It's not good for anybody. And when you express that to somebody, they shake their head and they're like, yeah, you're probably right. So if you think about what creates a good relationship, those are the things.
Yeah. It's a win for both parties anyways.
100% it is. And that's what everybody wants. Everybody wants the back end of the deal to be a success. Whether you plan on being there for, all the way until the second company sells, or you're only going to be there for 2 years, everybody wants it to be a win.
So yeah, thank you for going over that, the equity roll forward. And you went over a little bit in the beginning about the seller earnout. Is there anything else to note from the seller earnout piece that we should talk about?
I think those are really the most important things. Make sure you have control over how you operate the business. Make sure you have the right measure, whether it's EBITDA or gross margin or revenue. Hardly anyone does it on revenue, but gross margin can work just as well. Make sure the target is appropriate and make sure you have the ability to catch up or make up on any shortfall in your first year or whatever the case may be.
Todd, first of all, thank you. Everyone should check out your website, PotomacBusinessCapital.com. I think I don't know if we'll call the episode this, but 2 sentences that could gain you an extra $3 million would be
or double your value. In this case, it's exactly what happened. Yeah.
Would be a good one. But I will have to re-listen to this. I hope everyone, if they didn't catch all that, they can, re-listen to all of that again. Todd, besides PotomacBusinessCapital.com or Todd at PotomacBusinessCapital.com, are there any other places online, or are those the best places to point people towards?
Yeah, I think that's the best. You can also find me on LinkedIn. I'm happy to connect. Let me know you listen to the podcast. And if you want to talk, we're happy to do that. We're always happy to meet other entrepreneurs and see if there's ways to be helpful.
Any other episodes that we could point people towards today to check out more?
Gosh, we've got a few of them, recorded yesterday with M&A Advisor. We did a really great transaction for him. He actually, he got all of his earnout, which was scheduled for 2 years. We got it in 1 year because he really performed well. And he's decided he's going to move on as opposed to staying on board. But he's thrilled with the language that we got accomplished for him. We get into a little bit of the detail on that conversation. I've got a couple of others coming up and a couple of deals that we'll announce hopefully in the next 2 or 3 weeks. And there'll be some specific examples of the things we talked about here.
Check out that, much more. Todd, thanks again.
Jeremy, thank you.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.